Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Let's start with our Module 5, Expert. Before we dive into the first lesson of Module 5, let me give you a brief overview on what topics we are going to discuss in this module. Lesson 1, Commitments of Traders Report. Futures traders have access to the Commitments of Traders Report each week. This report provides insights on how large institutional traders and small speculators are positioned in each market. This lesson will guide you on how to read the COT report. More importantly, I will teach you how to interpret the COT data. We will be able to use these reports and see where big money is moving and how novice traders might be trapped. Based on a crude oil example, you will learn how to combine the COT report and our supply and demand strategy to anticipate a trend and to find low risk, high reward and high probability trade opportunities. Lesson 2, Fundamentals for Commodities. This lesson explains why fundamental data is essential to futures traders as well as what kind of economic activity are crucial in affecting price movements. I will show you how to read commodity reports and how they can be used to evaluate whether there are any physical supply and demand imbalances. Based on 2 case studies, you will learn how to connect the fundamental and technical dots to find high quality trading opportunities. Lesson 3, Seasonality. What if we knew that, for instance, heating oil demand is seasonal and that prices tend to rise from January through April when demand for heating oil is highest? In this powerful lesson, you will learn about one of the most significant forces influencing commodity prices: seasonality. Seasonal fluctuations are evident for many commodity prices and play a key role in influencing their prices. I will teach you how to combine seasonal patterns with our supply and demand strategy to increase your odds and to anticipate more significant moves in advance. Lesson 4, Correlations. What is correlation and how do we benefit from it in futures trading? To be an active futures trader and to recognize your exposure, it is essential to understand how different futures markets move in relation to each other. In this lesson, I will show you how to eliminate double exposure by using a correlation matrix. I will pinpoint existing correlations between certain futures markets. On top, I will demonstrate how these correlations help reducing risk through diversification and increase the probability of success when existing correlations are used to enter a trade. Interlinking our powerful supply and demand strategy with existing correlations will help our decision-making process and give us further confidence when entering a trade. In Lesson 1, we will cover the Commitments of Traders Report. In this lesson, I'm going to introduce a new type of report called the Commitments of Traders Report. We are going to define it, learn what information it contains. Then we are going to talk how we can use this information to increase the chance of success in our trades. And towards the end of our lesson, I'm going to demonstrate how we can insert this report, modify it to suit our needs into TradeStation, and how to take advantage of it to maximize the chance of our success. Let us begin. The Commitments of Traders Report, or abbreviation COT, is provided by the Commodity Futures Trading Commission. This is the agency that governs and regulates the futures and options trading in the US market. Now it contains historical records of futures contracts traded under the US market and US exchanges, and it is broken down by the position type, either a long position, a short position, or a spread position. And the report is broken down by trader type, whether it's a commercial trader or non-commercial trader. We will talk a little bit more details about these 2 different trader types in a bit. Since 1962, the Commodity Futures Trading Commission started asking traders to report their futures position, and specifically the traders who met a certain criteria that is required by the CFTC itself. Now they were requested to report the position that they were holding, whether it's a long position, short position, or spread position. And this information was published or is published on the CFTC website every Friday at 3:30 p.m. Standard Eastern Time. So it is only done once a week. It's not a real-time information, so it will not be very efficient for us to use this report for daily income trading. So looking at this information and reading this information that is published on a weekly basis, what does it give us? Well, it helps us to find out which groups of traders have a certain position bias in the market, whether these are the commercial traders or the non-commercial traders, and also which groups are driving the market trend. So if we see we have a solid uptrend going on, who is behind the solid uptrend? Is it the small speculators or the large speculators? We'll learn about that in a bit. And also which groups, whether commercial or non-commercial, are adding to their long position or adding to their short position or decreasing vice versa their position. As I mentioned earlier, we have two types of traders that are listed within the COT report. These are the non-commercial and the commercial traders. Let's talk first about the commercial traders. So these are the traders that use the specific commodity products in their line of business, primarily for either hedging in their business or to actually for their own production. So for instance, you would have General Mills, they would use a lot of the food products or grain primarily. Toyota might be using a lot of steel, Starbucks, the futures product coffee, farmers also for the agricultural product, banks, currencies, treasury notes, equities. Airlines, they could be using crude oil. So different businesses have different needs for these futures product. And if they are using or if they are trading these futures products, buying or selling them for the purpose of their own business, whether it is to hedge their business or for the purpose of production, they are classified under commercial traders. Now, the other groups of traders, these are the non-commercial traders. Within the non-commercial traders, we have two subgroups. These are the small speculators and the large speculators. Now, let's first talk about the large speculators. These are the ones, primarily the hedge funds, and these are the traders who are trading for other people's money, if you will. So they are hedge funds or commodity trading advisors, pension funds. And also they could be private traders, but they are trading very large size above the reportable size, and consequently they have to report this information to the CFTC on a weekly basis. These types of traders, they go under the large speculators. Now the small speculators, these are the ones, well, that's basically us. These are the retail traders, and those are the ones trading under the reportable position size. So if you're trading 1 or 2 contracts of crude oil, of wheat, of whatever futures product, you're probably going under the small speculator section. So the question is, as retail traders, if they don't have to report this information, how do they know about it? Well, it's basically by elimination or by subtraction. So we'll see that in a bit once we go to the official website and take a look at an official COT report. Here we have a snapshot of a COT report for crude oil, and it is traded under the Chicago Board of Trade. And we can see that we have the 3 groups of traders: the non-commercial, commercial, and the non-reportable positions. Now, the non-reportable positions, these are the small speculators. That's just another terminology for it, but it's the same group. The commercial, we talked about them, they are divided between long and short positions. And the non-commercials, we talked about them as well. These are the big traders who have to report their position size because they are trading above the reportable size, and the traders who are trading for other people. The advisors, the hedge funds, divided between long, short, and spreads. Now, the numbers here are how many contracts are being held. So right now, for instance, as of the date of this report. In terms of the commercial traders, there was 392,697 long position being held. Alright, these are long positions that have been opened and not yet have been closed as of the date of the report. For the non-commercial traders, so the large speculators, if you will, how many thousands of long contracts that are being held, how many thousands of short, and how many thousands of spread positions are being held. Now, the non-reportable, as we referred earlier, these numbers are derived by simply subtracting the commercial and the non-commercial numbers, because these are reported from the total. The total is obviously known information, it's derived from the exchange, so the non-reportable is nothing but a subtraction of the commercial plus non-commercial from out the entire volume of trading for that specific reporting period. The official website through which the Commitments of Traders report is released is the CFTC official website, cftc.gov. So let's go quickly to the website and we'll see what the report is. We'll take a look at the sample report and we'll see what information is provided there. This is the official website for the Commodity Futures Trading Commission, cftc.gov. And from the homepage, to reach the Commitments of Traders report, you go to Market Data and Economic Analysis and Commitments of Traders. Simply click on that. From here, under this section, we can choose what type of product we are looking for. So if we take, for example, one petroleum product and we go forward to the futures section only, the long formats, just click on that. We end up with a long page of information. We don't have to be overwhelmed by this information. Let's just quickly take an example. A futures product that is a petroleum product, which is the typical crude oil. So with a simple search for a light sweet, because that's the official name of crude oil, we see that we have crude oil light sweet WTI West Texas Intermediate. This one's traded under the ICE exchange. We want the one that is traded under the NYMEX exchange. So we are going to look at this information belonging to this product here. So this entire section here is for the numbers. These numbers all belong to the light sweet crude oil under the NYMEX. We can see how much open interest we have, how many millions or thousands of contracts, and producer merchant. These are the commercial ones. The reportable positions, swap dealers, managed money, and other reportables, these are the non-commercials. So we have got the commercials, the non-commercials, and these small speculators, or the non-reportable position size. Now, all this information by itself is of little use for us, because this is okay done once a week. And if we see that there is 93,075 long positions held right now by small speculators, then how does this help us? By itself, these numbers are not very helpful. What is very helpful is the trend that gets developed from the numbers that get reported week after week after week. So what we need is a tool that shows us the movement or the trend of these numbers week after week, and based on these trends we will learn how to use this information to increase the chance of success in our trading. Let's go back to the slides and continue our lesson from there. So now that we have learned what the COT report is, how we can find it, and what information it contains, now how can we use this information to increase the odds of success in our trading? Well, one way we can do that, one way we can use the COT report, is to basically identify what the novices are doing. Now, the novices are typically going to be gathered or grouped under the non-reportable, non-commercial section, as we have seen earlier of the report. So most of the positions that are reported or that are calculated under the section non-commercial, non-reportable, most of them probably belong to retail traders, And as we know, most retail traders are uneducated and novices in trading in the trading business. So consequently, we are talking about the consistently losing traders. So it would be helpful and advantageous for us to understand and to know what such traders are doing in the market and what kind of position bias they have. One analysis technique that is available in TradeStation is called the COT net position. I'm going to demonstrate how to use it in a bit. Now, this analysis technique, what it does, it shows the net open interest position, and by net we mean the long minus the short, alright? So it does the difference between the long position, open interest long and open interest short, and it plots this information for every group of traders, the commercial, non-commercial and small speculators. Now just for FYI, when we say small speculators, we mean also the non-commercial and non-reportable. That's the same type of group, just slightly different terminology. So by focusing our attention on what the small speculators are doing, the retail traders, the novices, the uneducated, the consistent losing traders, this is all different terminology for the same group, we can look to take the other side. So if we see that the majority of the small speculators are building long positions, then it would be probably more advantageous for us to consider taking the other side. This is nothing but an extra zone qualifier that can increase the chance of successful trade. However, we have to always use it in combination as a secondary support tool for the primary tool, which is always supply and demand. Such type of analysis and using the COT net position analysis technique should only be used on the higher time frames, such as the weekly and the monthly. The reason being is that the COT report is only released once a week. And as I mentioned earlier, using it for short-term trading is not going to be very efficient for us. Here we have a snapshot of the Nasdaq in the futures market, a weekly chart of the Nasdaq. At the bottom of the chart we have the COT net position analysis technique that's been plotted. Notice that it contains 3 separate lines. The green one is indicating the net open interest long minus short of the small speculators. The blue one is for the non-commercial large speculators. These are the hedge funds and the managed money, and the red one is for the commercial traders. These are the Starbucks, the Toyotas, the General Mills, etc. that we have seen earlier. So what we have to understand here is that every time one of the plots is above the 0 line, it means there are more long positions, open interest long positions being held than short positions. Because remember, that's the net difference between long and minus short. And every time the line is below the 0 line, so it's a negative value, it means there are more short positions being held than long positions. So how can we use this information? Well, we said that we want to focus our attention on the small speculator section of the COT report. So we are going to learn in a bit how we can slightly modify the COT net position analysis technique to only show us the small speculator section. So basically the green line without the need to focus on the other 2 groups. And we are going to see or look for a specific pattern or specific behavior. So on the higher time frame, such as the weekly here, when we see that price is dropping into an area of demand, and at the same time we see that the small speculator COT net position is also decreasing, it means the small speculators are building or adding more and more and more short positions and closing more and more long positions. So what can we derive? Price hitting a higher time frame demand zone and novices building or adding short positions. What can we anticipate? Well, we can fairly anticipate a reversal in price. We can use this information off of the higher time frame to do what? To go down to the lower time frame and look for high quality setups. Here we can see the same snapshot we had earlier on the Nasdaq weekly chart. Price was hitting a higher time frame demand zone, and at the same time the COT net position was decreasing in value. So more short positions are being held. Once this is noticed, we go down to the smaller time frame, to the lower time frame, in this case the 480-minute chart, and what do? We look for high quality demand zones and we look to place our set, stop loss, entry and target on this demand zone in order to take advantage of the price reversal. The same thing can be applied vice versa. If we notice that price is hitting a higher time frame supply zone, it's not represented here, but simply mirror image of everything we just discussed here. If we see that price is hitting a higher time frame supply zone and at the same time the small speculator group CUT net position is increasing in value, this is suggesting that the small speculators or the novices are adding more long positions as price is rising and rising into a higher time frame supply. So we want to take the other side. So what do? We go down to the lower time frame and we look for high quality lower time frame supply zones to set our position there. Let us now go to TradeStation and demonstrate how we can insert as well as modify the CUT net position analysis technique, and demonstrate an example of how we can use it to increase the chance of success of our trades. Here we are in TradeStation. We have right now the weekly chart for crude oil. We'll work with this one. And because remember, we set the CUT net position analysis technique, we can most take advantage of it when applied on higher time frame, weekly and monthly. In order to insert this analysis technique, what we would have to do is simply click on this insert analysis technique icon or right click and go to insert analysis technique. Now we have to look for the CUT net position. That's the analysis technique that we are looking for. Simply click OK. So what we see at the bottom, that's the analysis technique, the CUT net position. And we can see the three plots. On your TradeStation platform, the red one, it's showing the net position for small speculators. The pink one for non-commercial or for the large speculators, that's the managed money. And the blue one, that's for the commercial traders. What we want to do right now is, as we mentioned in the slides, we want to focus our attention on the red plot. That's the one for the small speculators. However, it's difficult to see whether the red plot is rallying or dropping because the entire scale has to include all the other plots as well. And in case of crude oil, we can see that the values or the numbers of the contracts traded by the large speculators or commercials is much bigger than by the small speculators. So we need to do a bit of modification in order to be able to focus and notice what the red plot is doing. To do so, we just have to slightly, nothing too technical, to do a bit of modification to the codes of the plot of the analysis technique itself. To do that, we just right click on the analysis technique and simply click on Edit Easy Language for CUT net position. What this will do is that it will open the easy language file for this analysis technique, and slight modification has to be done. Simply scroll down almost all the way to the bottom and we notice here that we have plot 1, plot 2 and plot 3. What we want is we want to keep plot 3, which is for the speculators, and we want to hide or eliminate for now plot 1 and plot 2. To do that, just click on just before plot 1 and type or include 2 slashes. What this will do is that it will make this line as a comment line, if you will. We do the same thing for plot 2 too. We include 2 slashes and we keep plot 3 unchanged. Once we do this, we click on the green check mark sign to verify and to apply the changes, and we go back to the charts. Now we can see here that the blue and pink plots have been eliminated, and now we only have the red plot, which is indicative and it's only showing us the small speculators. So let's go back to the slides. Here just quickly, you can also take a screenshot of that, the 3 steps that I just explained on how to modify the CUT net position analysis technique. From what we have learned from the slides, what we are looking for areas on the chart where price is moving in one direction. For instance, price is hitting an area of supply. We have a drop area of supply here. As we can see, prices hitting this area of supply right at this point. And at the same time, we can see that as price was rallying towards this area of supply, what were the small speculators doing? Well, what we can clearly see is that they were building up or increasing what? Their long positions. So notice this, price was rallying to supply. At the same time, the novice speculators were building their long positions. This is what? That's a recipe for reversal, because this is typical market timing, price hitting supply in an area where the chart is objectively telling us there's more supply than demand, and at the same time we have novices making their big mistakes. They are the two big mistakes, in this case buying at supply and buying after a rally in price. And we can know that they are buying because of the CUT report, the CUT net position analysis technique here. So once identified the weekly supply zone, we can place our set there, or we can go down to the smaller time frame, the lower time frame, and look for high quality supply zones in order to set our position. Now once we are done with our analysis and want to change it back, the CUT net position, to its original situation, well, we simply go back to the easy language page or the development environment and simply undo our changes that we did before and click on verify again. So, what have we learned during this lesson? Well, I introduced the commitments of traders report, or the CUT report. I introduced the information that is provided within it, the types of positions, long, short or spread positions, and belonging to which groups of traders, the non-commercial or the commercial group of traders. And using this information, we talked about how we can take advantage of it to maximize or to increase the odds of success in our trading. I demonstrated how to add the analysis technique CUT net position into TradeStation, how we can slightly modify it in order to focus our attention only on what the retail traders or the novices are doing. Now we know how to take advantage of that and look to trade the other sides. That's it for this lesson. In the next lesson, we look into fundamentals for commodities, so stay tuned for the next lesson.